What is happening, guys and gals? Joe Badger here, your money mentor, where we have deep pockets and short arms. Mutual funds. When it comes to investing in the stock market, what are these crazy financial products? Are they better than individual stocks? Are they safer? Are they going to make you more money? Well, we're going to explore all of those points and a lot more. And I'm going to try to help you with my nearly 40 years of experience with the stock market in understanding mutual funds a lot better. Whether you are a beginner investor or intermediate, or if you just want to know what is a mutual fund and how does it fit into your overall strategy and investment portfolio, well, you've come to the right place. So make sure you hit the subscribe button because we have a lot more coming and you do not want to miss out. So let's get into mutual funds and figure out what are these crazy things. I've always had a thing for mutual funds because it was one of the very first things I invested in when I started my investing career. Right out of high school, I remember going to the library, and that's how you had to do things back then. And I had to ask one of the librarians to help me out, and we went to the financial section, to the investing section. I got all this paperwork, and I did my homework and researched a bunch of different mutual funds because I heard that mutual funds were a little safer than individual stocks. So I looked through different sectors, especially the performance, and I found a good one. Then I put about $2,500 into it. In less than a year, I made 35%. It was a real grower. I think I got lucky. I had to cash it out because I had some medical expenses at the time. So I had a really good first experience, and it was with a mutual fund. So I always liked investing in those from the very start. So what is the main difference between a mutual fund and an individual stock of a company? Well, when you're investing in a stock of a company, and let's just use Ford Motor Company as an example, just an example, you're only buying one company. But when you invest in a mutual fund, you're buying a lot of companies, maybe as many as 100 companies in that whole collection. So the name mutual fund really refers to a collection of stocks, a collection of companies, a grouping. You may have also heard the term a basket of stocks, but basically it's a lot of companies. And usually those companies are within one sector or with one area, such as growth or value or small cap, or they can be in different sectors like healthcare, real estate, financials. They're usually divided up, but when you buy a mutual fund, you're buying a lot of stocks. But you're only paying one price, just like you would for an individual stock of a company. Now, the main difference is, the theory is there is safety in numbers, that it's going to be a lot slow moving, it's going to be a lot less volatile. In other words, it's not going to be as risky, it's not going to move up as quickly and as fast, but at the same time it's not going to move down as quickly or as fast. And therein lies the theoretical principle of safety. But make no mistake, you can lose money on a mutual fund just like you can in individual stock. The other big difference is, since there's so many stocks in that one fund, usually there's a manager, and that manager is assigned to actually actively, they call it active or passive managing, he's actively assigned to update those stocks every year and make sure that they're good companies and he's in the right companies and that the performance of the mutual fund is doing well. The other big thing that you need to know that distinguishes a mutual fund from an individual company stock is that you cannot view the performance in real time. When you open up your brokerage account and you're watching your stocks, you can see them go up and down basically in real time, or at least during the day you can see the prices change. With a mutual fund, you have to wait till the end of the day, till they close a bell, which is after 4 o'clock, and then a few hours after that for them to take the average price of all of those, let's say 100 stocks, just for example, and find out if the mutual fund had gone up that day or gone down. So when you're watching the performance of the mutual fund, you have to wait till the end of the day, and you're going to see the aggregate of all of those stocks, how they perform, that whole sector, before you see the change in the price of the stock, or the mutual fund, I should say. Some other mutual funds that I think you should be aware of and are worth investing in are either ETFs or index funds. Now, these differ a little bit from a typical mutual fund and definitely differ from an individual stock. So, like we said, a mutual fund is a collection of stocks, and because it's a large collection of different companies, you have to wait till the end of the day to see how that individual mutual fund performed. Well, with an ETF, an exchange-traded fund, this is something that was invented relatively recently, and it's not as old as mutual funds. But these will trade in real time, and you can see them go up and down during the day. Both with the ETFs and with the mutual funds, you can go on your brokerage account or do a search, and you can find all the different individual companies that are included in a mutual fund or a collection of companies. You can see the top 10 holdings. That's normally where the higher percentage of investment is allocated. But you can see all of the individual stocks too if you dive a little deeper. An index fund is another product that's very interesting and worth investing in. And an index fund, once again, is a fund, so it's a collection of stocks. But this collection follows an individual index, whether it is the NASDAQ index or the S&P 500 index or the overall market index. It's going to mirror what the index does. And the advantage of that is there are very little fees, there are very little expenses that go along with this type of fund, because it doesn't need to be managed. It doesn't really need to be followed. They're not really taking stocks in and out and doing a lot of work, seeing if it's keeping up and performing well, because it's just mirroring the market as the market moves along up and down throughout the months, throughout the years. So those are really good funds to invest in as well, and that is an index fund. Now, you'll hear a lot of people talking about beating the market and beating the indexes. And a lot of people don't like index funds for that reason. They think they can outperform the actual market. If the overall market did 10% in any one given year, people, investors, would hope to make more than just 10%. And hopefully you don't want to make less than that. But an index fund will make whatever the total market does or the market does for that index, and it won't outperform, it won't beat the market. But from my experience in all my years, I have found that index funds are great. And remember, you're only going to allocate some of your money to any one investment, whether it's 5% of the money that you have to invest or what have you. So you're not going to put all your eggs in one basket, but it is definitely a good product to buy, and you can look those up. The index funds, like I said, are going to be divided into different categories, as in the tech index, the small cap index, the S&P 500 index, and the overall market, also international indexes as well. All right, now let's get into the individual mutual funds that are the best products for you and for your financial investing. Now, as I said, there are a lot of different sectors. You can buy a mutual fund in healthcare, in real estate, in finances, in technology, in commodities, in industrials. It goes on. So there's a lot of mutual funds out there, and it can get very confusing. Which ones do I buy? Which ones will be good for me? Where do I start? Well, luckily you have me. I just did a great search, and I found out, I went to my brokerage firm account and I looked at all the different categories, and I found out that the best ones to buy, and this is from my opinion, the best ones to buy mutual funds will check these boxes. First of all, a 5-star ranking. When you look up the mutual fund, it's going to give you a choice of rankings. Do 5-star. It's usually a Morningstar 5-star ranking. And then you're going to want one with high returns. It gives you an option. Do you want one with low returns or high returns? Well, high returns always. Expenses, you're going to want one with low expenses. There's always a little bit of fees, a little bit of expenses associated with a managed mutual fund. So when you look it up and you see the category for fees, you want very low fees. Well, U.S. equity, in my opinion, I would stick to U.S. equity at this time, and I would not invest internationally. That's just my opinion. Also, there's a category of transaction fees. This is going to whittle your search down very small because there's always a little bit of transaction fees. But that is an option. If you can say no transaction fees, you're going to have less of a choice, but it is a box to check. Another one is minimum, he tried to speak English, minimum investment. And many mutual funds will require a minimum investment of $1,000, $2,500, $10,000. Well, they pretty much earned that minimum investment through performance over time, or at least that's the theory. So I always check the box 0 minimum investment. In other words, you can invest $10 if you want. And then there's active management. Active management is usually the best type of mutual fund. You have someone looking it over, you have someone actually paying some attention to it, and that's going to hopefully avoid some of the pitfalls over time. When I did that search with all my criteria here, I came up with 56 choices. But think about that, 56 choices of 5-star, high return, low fees, U.S. equities. These are all really good, strong mutual funds. Now, they're going to be a list of different companies who sell these mutual funds. It could be sold by Fidelity, by Schwab, by BlackRock, by Vanguard. There's probably a million different companies who sell mutual funds. So don't worry so much about the company selling the fund as I would concentrate on these checked boxes, whether it's a 5-star or a low expense or a high return. Also, you want to then, after you have 56 to choose from, in which case I did, then you look at their performance. You're going to look at their 3-year performance, 5-year performance, 10-year performance, lifetime performance. And you're going to see who does the best, where you had the best returns over a long period of time. And 3-year, the short term, isn't always the greatest because every year is a little different. And even a good mutual fund is going to have a bad year. And it may have not have been a good mutual fund last year, but it is good this year for all sorts of different reasons. So I think this is the best way to do the research and look up a mutual fund and find the best one for you and for your investment strategy. All right, so in conclusion and summary, I hope you know a little bit more about mutual funds and what they are. Keep in mind that when you're buying an individual stock, like a Ford Motor Company, just for example, you're buying one company. When you buy a mutual fund, you're buying a lot of companies, and there is safety in numbers. Remember 2 things. All in all, don't put all your eggs in one basket. And number two, now is a good time to invest.